Silver didn't just dip, it detonated. In a matter of hours, billions in paper value evaporated, traders panicked, social feeds lit up with, "That was the top," and once again the crowd declared the bull market dead. But here's the part nobody wants to slow down and examine. Nothing structurally broke. Not the long-term momentum, not the multi-decade base, not the relative breakout versus gold. What broke was confidence. And when confidence breaks before structure does, that's usually where opportunity hides. Let me walk you through what I'm seeing, because this isn't about hype, it's about mechanics. Silver has been trapped in a psychological and technical cage for roughly 50 years. Think about that. 5 decades oscillating between roughly $4 and $50. During that same half century, we saw currencies diluted, money supply explode, debt go vertical, equities multiply, real estate soar, and silver. It went nowhere in real terms. It was compressed, suppressed by inertia, ignored. Markets that live in a box that long don't gently step into a new reality. They erupt into it. The drop we just witnessed was violent, yes, but violent drops inside early-stage breakouts are not uncommon. In fact, they're classic shakeouts. Real structural tops, the kind that mark the end of major cycles, almost always show long-term momentum deterioration first. You see trend lines snap on weekly and monthly charts. You see multi-year momentum structures roll over in unmistakable fashion. That's not what just happened. What happened was emotional damage, not technical destruction. If you study historical blow-off tops, 1980, 2011, you can actually see the warning signs in momentum well before price completely collapses. Those signals are absent right now. Long-term momentum hasn't imploded. There's no major structural fracture, and that matters more than the headlines. Now let's talk about the breakout itself. When you analyze silver on a long-term arithmetic chart, the old range was roughly $5 to $50, about a $45 span. Traditional textbook analysis says when price breaks above a range, you add the thickness of that range to the breakout point. That would project roughly $95. And interestingly, when silver approached the mid-90s recently, heavy selling showed up. Many traders assumed objective met, move over. But here's the problem. That measurement is too small for a 50-year base. When price blasted beyond that level and kept running, it told you something bigger was in play. Arithmetic targets underestimate percentage expansions after generational compression. Switch to a logarithmic lens where percentage growth matters more than dollar increments, and suddenly the scale changes. A tenfold expansion from the lower end of that half-century range projects toward $500. That sounds outrageous until you remember what copper did after decades of stagnation, or what lead did after years of dormancy. They didn't crawl higher. They quadrupled in a handful of quarters. No slow transition, just repricing. When a market decides it has been misvalued for decades, it doesn't apologize politely. It corrects aggressively. Now let's bring gold into the conversation because the silver to gold relationship is flashing something critical. Not long ago, silver was trading at about 1% of gold's price. Historically, during major precious metals expansions, that ratio has been dramatically higher. In 1980, silver held around 6.5% of gold's value for a meaningful stretch. In the 2010-2011 surge, it exceeded 3%. So when silver sits at 1%, that's not balance, that's distortion. Recently, that ratio climbed above 2%, and more importantly, it broke out from a massive multi-year base on the relative performance chart. When silver begins outperforming gold after a long dormancy, that's usually when the explosive phase begins. We're not years into that move, we're months into it, and that distinction is everything. Now, I know what some of you are thinking. Silver has crashed hard before after big rallies. True, but context matters. Those collapses followed extended euphoric vertical phases. We're not deep into mania at $400 or $500. We're early in a breakout from a 50-year compression chamber. If silver were already trading at $450, I'd be warning about unsustainable extremes. But we're nowhere near that scenario. The old $550 reality is likely finished. The new question is where the upper boundary of this new pricing regime settles and how violently it overshoots before stabilizing. Because markets that correct decades of mispricing often overshoot fair value. If equilibrium suggests $250 or $300 based on monetary expansion alone, history shows speculative waves can push beyond that before gravity returns. Speaking of monetary expansion, look at M2 money supply from 1980 to today. The increase is staggering. If silver simply adjusted proportionally to monetary dilution, you'd already be looking at prices far higher than where we sit now. The same logic applies to gold. Gold rose eightfold from the mid-1970s low to 1980. It did it again from 2001 to 2011. Similar magnitude. Yet from the 2015 low, gold hasn't matched those historical expansion multiples under far more extreme debt conditions. And still, people say it's overbought compared to what? A memory of suppressed volatility. Now let's address timing, because timing is where most investors get hurt. If you buy euphoria at vertical highs, you risk getting trapped in a correction. But when early-stage breakouts shake out weak hands violently, that's often when stronger positioning develops. Short-term momentum indicators are already stabilizing. The panic was sharp, but brief. That's important. True structural breakdowns don't recover quickly. They grind lower with persistent weakness. That's not the behavior we're seeing. I also want to talk about miners. Mining equities have spent more than a decade trading at depressed relative valuations compared to gold. They've improved modestly, but they remain contained within a long performance range. If that range breaks upward, the leverage effect could be dramatic. Historically, miners tend to accelerate after metals confirm sustained breakouts. Silver's identity is also misunderstood. Many investors view it purely as an industrial metal. But silver has been a monetary metal for thousands of years. Its monetary history rivals gold's. The industrial narrative overshadows that fact, but it doesn't erase it. In certain regions globally, silver's monetary relevance is quietly re-emerging in transactional frameworks. Now contrast this with what we're seeing in parts of the crypto market. Bitcoin showed layered advances over the past couple of years, but long-term momentum failed to confirm those final highs. Structural breakdown followed. Ethereum has been even weaker, revisiting price zones not seen in years. When long-term holders find themselves underwater across multiple cycles, sentiment erosion can become structural. The broader lesson? Not all alternative assets carry the same historical weight under stress. Precious metals have millennia of monetary credibility. Crypto is still a young experiment, and when financial instability intensifies, capital tends to seek durability. Meanwhile, companies that piled into digital assets during speculative surges may now face balance sheet vulnerability. Exposure that looked innovative during upside momentum can look dangerous during downside acceleration. Against that backdrop, silver's recent collapse looks less like failure and more like a violent test. Nothing in the long-term structure says the breakout failed. Nothing suggests we've been shoved back into the old 50-year cage. What changed was psychology, and psychology can reset in days. If this is indeed a generational repricing event, it won't move smoothly. It will be volatile. It will scare people. It will overshoot. And eventually, yes, it will likely correct sharply from extreme highs, but that phase appears ahead, not behind. Right now, what I see is a market that broke free from decades of suppression, surged aggressively, corrected abruptly, and is stabilizing without structural damage. That's not the end of a story. That's the turbulence at the beginning of one.